Hi, everybody. Welcome back. Today, I want to talk about labor market discrimination. And this is within the context of racism and labor market disparities and wage differentials. And this is something that is incredibly well documented. So I'm not going to spend time today talking about wage disparities or disparities in unemployment rate, labor force participation rate, and other dimensions of labor markets, just because I consider it pretty well documented. And if it's something you want to see, let me know and I'll put it together. But what I want to talk about today is the idea that labor markets can solve the problem of discrimination. And this comes from the realm of neoclassical economics. And so when we think about this sort of early economic theorists talking about discrimination and labor market disparities, they had this idea that, if markets worked correctly, if labor markets worked correctly, then labor markets could be expected to solve the problem of labor market disparities. That basically we didn't need any intervention, markets could handle it themselves. And so that's what we want to address. To do that, though, we're going to need a functional understanding of how labor markets work. And if you are in my economics of racism class and you're not an economist, that might be something you're not 100% familiar with. So today we're going to start out by looking at how labor markets work. We're going to derive a labor demand curve by looking at how economists measure worker productivity, and then we'll build on that to start to talk about how a labor market could attempt to solve the problem of labor market disparities. So let's get started. I'm going to bring my whiteboard a little bit closer so it's a little bit easier to see. There we go. So the idea here is that we want to first build a traditional, simple labor market model, and then we're going to go ahead and, based off of that, look at how a market could solve disparities. Okay, so we're going to start with an example that I've used a lot before, and this is just a simple example of a market where it's really easy to tell how productive workers are. So we're going to look at a company where there are workers producing coffee mugs. And what we need to know to start out is how much does each worker produce and what's the price of coffee mugs. And we're making a couple of assumptions here. Pardon me. We're making the assumption that all the workers are equally productive, and we're making the assumption that there's fixed capital. And so that just kind of means there's this office here where they're all working, and I'm going to draw a little kiln for them to bake the coffee mugs in, and maybe we'll put a little, I've been working on these drawings for a while. There's a little coffee mug. So this is the shop, right? And they can have 0 workers, 1 worker, 2 workers, 3 workers, 4 workers, 5 workers. We could keep going, but this is just for the sake of our purposes. We're going to go through and do this. And the idea is, as we increase workers, we're going to increase our output. And that's what this is here. Output is just the quantity of coffee mugs being made given the quantity of workers. So if we hire 1 worker, we're going to be really happy because we're going to go from producing nothing to producing 6 coffee mugs. So this first column here is marginal product of labor. And marginal product of labor is just how much does each worker produce? What's the product, the additional product, the additional productivity that worker brings? So we're looking at how productive this additional unit of labor is. So when we go from 0 to 1, we're going to go from producing nothing to producing 6 coffee mugs. So the marginal product of that labor is going to be 6 coffee mugs. So far, so good. Now we want to hire another worker. And this is going to be another person here. We're going to put them in the kiln room. They're going to help with the coffee mugs. And that's awesome. It's going to make our company more productive. Now, with 2 workers, we're going to produce a total quantity of 11 coffee mugs. Now we want to calculate the marginal product of that second worker. So when we go from 1 worker to 2 worker, we're going to go from 6 coffee mugs to 11 coffee mugs. So another way to think of marginal product of labor is that it's going to be the change in quantity divided by the change in labor. Our labor is going to go up by 1, and our output is going to go up by 5. So our marginal product of labor is 5 divided by 1. This second worker produces 5 more coffee mugs. Make sense? So, make space over here. We have limited whiteboard space today. So this starts to give you a sense of how this goes. We hire a third worker. They're going to increase our productivity. But you can already see how in my little kiln, it's getting crowded, right? In this room, because we aren't adding any more equipment, any more space, any more building, it's going to get a little crowded. And so what we're going to see is this third worker is not as productive as the second worker, and the second worker isn't as productive as the first worker. So the third worker takes us from a quantity of 11 to a quantity of 5. That's a marginal product, an additional productivity of 4 coffee mugs. And we keep going, and we keep calculating that marginal product of labor as we add additional workers. And you can see how it begins to get quite crowded. Here's a fourth worker, and they're going to move us from 15 coffee mugs to 18 coffee mugs. That's an additional marginal product of labor of 3. And so we're going to tend to see this slowly decreasing marginal productivity because each additional worker added to a set office, a set building, a set factory, a set restaurant, a set farm is going to be a little bit less productive. We're going to get a little bit less bang for our buck with each worker. And that's what we're seeing play out here. By the time we get to the 5th worker, not only am I running out of colors, but we're running out of space. This worker is helpful, and they're trying to be helpful, but there's just not enough capital for them to be productive. It's the other example I use for this is the idea of having a food truck, right? You start to bump into each other. Even if we had a factory with 1,000 space for 1,000 workers, the 1,010th worker is going to start to slow things down. And that's this idea. We're using a small example so we can keep the number small. So our 5th worker takes us from 4 workers to 5 and takes us from 18 mugs to 20. So that's a marginal product of 2 additional coffee mugs. So now we have our marginal product of labor column, and that's awesome. But what we're going to do eventually is compare this quantity of workers to the wage. And the wage of our workers, we're going to assume they all are paid a wage of $100 a day. And so we want to be able to compare the worker productivity to what we have to pay them, because that's how we're viewing this problem. We're viewing it from the perspective of the employer. So the employer is trying to decide how many workers to hire based on their productivity, but we want to convert that productivity into dollar bills. So what we can do is convert marginal product of labor into value marginal product of labor. And value marginal product of labor is really easy to calculate. It's just the price of the good produced, P, times marginal product of labor. In this case, the price is $20. So we're going to just multiply this by $20 to get our value marginal product of labor. Does that make sense? What we're doing with value marginal product of labor is we're using a really long economic term to describe something really intuitive. How much does this first worker make for the company? And we can measure that in terms of the quantity they produce and the price of the product. So that first worker produces 6 coffee mugs at $20 a pop, at $20 each. That's going to give us a value marginal product of labor of $120. The second worker has a marginal product of labor of 5 coffee mugs. They bring an extra 5 coffee mugs to the table. Those 5 coffee mugs can each be sold for $20. So the value of that second worker is going to be 5 times 20, or $100. The third worker produces on the margin an extra 4 coffee mugs. Each coffee mug is worth $20. So that value marginal product of that third worker is going to be $80. And so we just go down and multiply each marginal product value by the price of the output to get the value of the productivity of each worker, given our circumstances. So the fourth worker produces 3 mugs worth $20 each. That's going to be a value marginal product of labor of $60. The fifth worker, 2 coffee mugs times $20 means we're going to have a $40 value marginal product of labor. So far, so good. So we see a couple of things here. We add more workers to a fixed office space or a fixed capital situation, and we're going to see the marginal product diminish over time. We're going to see the value marginal product diminish too. But what we're doing here is we're just converting the worker productivity into the earnings for the firm, how valuable each worker is to the firm. Now what we want to do is graph that relationship. So what we're going to do is we're going to graph the number of workers and the value marginal product of labor, with workers on the x-axis and value marginal product of labor on the y-axis. All right, it's going to look like this. Hopefully you've got your numbers written down. If not, I'll remember them. So we are going to have a market, with our quantity down here, and it's our quantity of labor. And we're going to go ahead and have our first worker, our second worker, our third worker, fourth worker, and fifth worker. And we know that our first worker is worth $120. So I'm going to go ahead and kind of put $100 here. And that would mean this is 50. I'll put 75 here. And that'll make this 25. So far, so good. And then this could be 125 up here. Try and hold on to scale as best I can. Now I want to graph that value marginal product of labor against the quantity of labor. So our first worker was able to produce $120 worth of output. Our second worker produced $100 worth of output. Our third worker produced $80. Our fourth worker produced $60. Sorry, I lost my place there for a second. And our fifth worker produced $40. If we connect these dots, we can go ahead and run it into the axis if you want. You don't have to. That's our value marginal product of labor curve. Cool? Yay! So that's a great thing we've got there. Now we want to start messing with it a little bit. And the first thing we want to do is go back to what I said previously. I said we're going to assume that we have a wage that we have to pay our workers, right? And that's going to be $100. If we have to pay each worker $100, regardless of how productive they are, regardless of who's hired, we can just draw that line and say, okay, each worker earns a wage of $100. It's a little bit off there. But now we can answer a really important question. How many workers should this firm hire? I'm realizing that's a little bit light colored. Let me fix it for you. If we want to know how many workers should be hired, we compare that wage to the worker's productivity. So, would we hire the first worker? Yeah, the first worker earns the firm $120 and only costs $100. That's a benefit, 100%. So that first worker is definitely going to be hired. Give him a little check mark. What about the second worker? The second worker also earns the firm $100. They're going to produce 5 coffee mugs, earn $100, and they're only going to cost $100. So we are going to expect the firm to hire that second worker also and give them a little check mark. But what about the third worker? The third worker can only produce $80 worth of output, only has a value marginal product of labor of $80, but costs $100 in wages. So it doesn't make sense for the firm to hire that worker or any subsequent worker. So what that means is, if we compare the value marginal product curve to the labor curve, or the wage curve, we can derive the equilibrium quantity of labor. That's how many workers the firm's going to hire. If we raise wages, we're going to see fewer workers be hired. What if the wage is $60? If the wage is $60, that's going to mean more workers are hired. And so what that tells us is the value marginal product of labor curve is a curve that tells us the quantity of labor demanded given the wage. So that means something really important. It means that the value marginal labor curve is actually the demand curve for labor. And that's the whole point of this activity. The idea here is that labor demand is a function of a worker's individual productivity. And that means that we can't assume that labor demand is going to be responsive to how productive workers are in the marketplace. Okay? All right. I'm running out of time, so I'm going to go through the next part a little bit quickly. So now we're going to assume that we have two markets with the same workers in them. The workers have the same productivity and the same skills. And we can talk more about differences that might emerge in these markets and other situations. But we're going to have labor demand and labor supply in both of these markets. And the price of labor, it turns out, is the wage, right? We're going to have a wage in each market. So what differentiates these two markets? Well, if we're talking about discrimination, what's going to differentiate these two markets is one of the many dimensions of discrimination. So we could be talking about race, gender representation, sex, protected class of any kind, disability, immigration status, all of those things. Whatever is the dimension of discrimination, that's where we're going to assume the difference is. For our purposes, I'm going to say that these are the market for men in this market, and this is the labor market for female workers, women. And they start out in equilibrium because both populations of workers are equally qualified. And then we're going to mess it up and try to fix it. We mess it up by having some employers discriminate. We know that there are workers and employers who are discriminatory. They're going to prefer to hire men over women for no other reason than just personal discriminatory preference, what Gary Becker, the economist Gary Becker, would call taste discrimination. And so what that means is he's going to demand more men and fewer women. I made it sound like Gary Becker is going to demand more men and fewer women. The discriminatory hirer. They're going to demand more male workers, and that's going to raise their wages and lower the wages of less in demand female workers. Oops. Okay? And so we see that. We see evidence of women's wages being lower than men, and maybe that's what's going on. Women's labor force participation rates have been traditionally lower. They tend to have higher unemployment rates. Maybe that's what's going on. It's just taste discrimination. So this is where we get to econ solving it. Neoclassical economics says that this wage disparity is just sitting there waiting to be exploited by non-discriminating firms. So long as there are firms who don't discriminate against women, they're going to come in and say, holy smokes, look, these low-cost workers, I'm going to hire some of them. And they will. They're going to increase demand for the lower-cost workers and decrease demand for the undiscriminated against high-cost workers until we get a little bit more of an equilibrium. And that's how neoclassical economics says that markets will solve this problem. We're going to see demand change until we get back to some kind of equilibrium where the wages for, in this case, men are going to fall, wages for women are going to rise until there's no longer a difference to exploit, right? So discriminatory employers are going to hire the group they like. Non-discriminatory employers are going to not hire that group and hire the other group until it all works out. What do you think? This is just one explanation. Another explanation comes from the world of political economy and public choice economics and says, actually, there's a lot more going on and that we need systematic change to alter many layers of discriminatory practices that lead up to and through the hiring process. And so they argue that markets are not enough and that we need policy change to help alter outcomes. What do you think? Let me know, and I'll see you next time. Have a great day.